Welcome to the Buy and Build podcast, the show where we explore the nuances of buying and building small businesses, with a focus on the UK and Europe. I'm your host, Paul. If you're interested in buying, building, or investing in UK and European small businesses, this show will dissect the strategies and insights of business owners, investors, and other deal professionals that I meet along my journey to acquire and invest in profitable small businesses. If you enjoy the show, please follow us on your favorite podcast app to stay up to date on all new episodes. And join the Buy and Build community at buyandbuild.co, where I share additional resources, deals, and ideas with the community. You can also find us on LinkedIn at Buy and Build and Twitter at Buy Build Podcast. This week's episode is sponsored by SME Capital, bespoke funding specialists for established SMEs. SME Capital was founded to support the growing number of SMEs who face difficulty or frustration in accessing capital through traditional methods. SME Capital was built by entrepreneurs for entrepreneurs. It's in their DNA. What makes SME a great solution for acquisition entrepreneurs is they're sector agnostic, comfortable financing asset-light businesses, and typically will not require personal guarantees. Also, their funding size ranges from £500,000 to £5 million, which is often the sweet spot for acquisition entrepreneurs, but unfortunately, an often underrepresented part of the debt financing market in the UK. So check them out at smecapital.com, where you can connect with one of their regional directors. And don't forget to tell them who sent you. Okay, well, welcome back to another episode of the Buy and Build podcast. I'm here today with James Kaberry. Am I pronouncing that right, James?
You can call me whatever you want. I've been called many things in my time, but Kaberry is how I pronounce it. But it honestly doesn't matter. Yeah, Kaberry. I got Cabelli. You used to get written all sorts of things, and they'd say, "Are you Italian?" I'd say, "No, I'm a Yorkshireman, really." And I just say K.A. Berry. The thing I sometimes like is, "Are you a Cadbury?" I said, "No, that would have a D in it and not a B." But anyway, I wish I had the money of a Cadbury.
All right. So, James, you have a fascinating background. So obviously, currently, you're the chairman of SME Capital. So the listeners will have heard about this because you've been sponsoring the last couple of episodes of the podcast, which we're really thankful for. So you're an innovative SME lender. And I think from my understanding, kind of speaking with the team, you created SME out of, maybe some of your own entrepreneurial paths in the beginning and kind of the frustration with the lending in that kind of level or that lower middle market space. So I'm keen to get into that. But in addition to that, you're also the chairman and joint CEO of Titan Wealth Holdings. So that's a discretionary fund management business, and it appears to be quite acquisitive too. So I'm keen to get your insights on these two businesses that you've built, and also perhaps discuss how acquisition entrepreneurs like myself and the listeners can best prepare for raising debt capital from a lender like SME.
Okay, great. Well, Paul, very nice to meet you. Finally, they're both subjects extremely close to my heart. I think the entrepreneurialism and that side of things is definitely extremely important. I think trying to obtain debt capital has been I won't say a nightmare, but has been difficult post-crisis. And I think most businessmen and women find this as a problem as they try and develop their businesses, whether it be for a £100,000 loan or whether it be up to almost a £10 million loan. I mean, I think no level within those two bookends it is easy at all. So I'll give you a bit of a story on SME. SME, we started back in 2014-15. It principally derived from the fact that I'd done a buy and build back in a business called Pantheon, which was an IFA rollout. And we had bought 8 businesses between 2000 and 2007. And we'd amalgamated them, consolidated them, and centralized basically head office resource, et cetera, et cetera. We'd used Bank of Scotland as a senior debenture holder within the business. It had worked extremely well. We'd run very simple models, which was 5-year term loans, and repaid all of it by the time we actually got to 2008. I think I was fortunate enough that I sold the business in 2007, and in 2010 I then bought it back again because the acquirer didn't want us anymore, which was quite beneficial in some respects. However, when we tried to do it again from 2010 onwards, it fell on deaf ears. I mean, the banks basically post-crisis turned around and said, no, you're not able to do this, put your own money in, which I was perfectly willing to do. But there were terms were so egregious, it wasn't really banking. It was banking with guarantees left, right, and center. It was guarantees with equity. And to me, that wasn't banking. And part of me felt very aggrieved by it. And part of me thought, especially, by the way, with the rates that they were charging. So I thought there must be a simple route to this. And SME was predicated on the back of the fact of providing institutional capital into a space that would be a lender. But it would be simple, straightforward, good business practice, good business principles, and something that most people can follow. And so SME was created, and trying to persuade the institutions to actually give money to lend onward was very difficult. I mean, when we first started out, they didn't basically understand. They thought default rates in the SME space were sky high. And so you have to educate them as to what the rates of default really are. And what it actually transpires, and we spent 3 years doing this, I might add, if you actually get the statistics for it, you find out that they're probably sub 2%. And in our book, which I would call the 1 million to 5 million pound lending space, which is our sweet spots, I would say they're sub 1% default rates. So you've generally got very good businesses that are long-term, family-owned. They might not necessarily be family-owned, but there are lots that are trying to do MBOs, MBIs, acquisitions, cash outs, all sorts of M&A activity. And they're just not able to get money at the levels that they want or without taking in private equity. And most people don't know the biggest issue is where do you find money and who is going to advise you? So we knew that we had a natural market because the banks were regressing and pulling back out of this space. And so we effectively set up SME to provide funding. We've now gone through the process of proving ourselves. So proving ourselves in terms of to institutions who will give us money and to lend out, and that the quality of our credit is good, the quality of our process is great, the quality of the businesses that we look at and lend to are excellent. And I suppose generally what we're doing is sensible. So where we get to in SME is that it came out of something that I'd been doing, which was what I call buy and build, and what everyone calls buy and build. And a lot of the loans that we provide are for buy and builds. There's a very interesting thing with buy and build. So take SME's standard core product, which is a 5-year term loan amortizing to the tune of probably 75% of the amount. One, the banks won't do it. But two, it's not necessarily 100% conducive unless you've got very high margin to doing buy and builds, because normally within a buy and build, what you need is the constant cash flow to generate and propel the equity forward. So I know I'm slightly contradicting myself, but a lot of what we do is to get that first acquisition done. It's to do a management buyout, to do a management buy-in, we've got an existing business, it wants to purchase Mrs. Miggins's business that's a bakery or whatever it happens to be. And they can't get it from the bank because the bank won't give it to them. But they know that this business is generating sufficient, plus they're existing, and they can go and do that next step. So what I would say a lot of our core SME product for is to do that first move in to starting a buy and build. Now, evaluation of what these businesses generate, I would generally say that buy and builds, if you're going to do a series of them and 8, 10, 20 different purchases, then you need a slightly different financing. You don't need amortizing money. You need bullet type money. And the problem with getting hold of bullet type money is it's generally slightly more costly because you're a higher risk potentially, but also you trying to get it access from a lot of the direct lending funds is they do normally start at 30, 40, 50 million pounds, and they need to be able to see that going forward. So we do have two products for this. We have a product that is the core product, which is what I call a standard 5-year term loan. And then we've just come out with a new product called Ascend, which is effectively a pure bullet, 100% bullet type product, 5, 6, 7-year term loan with 100% bullet. And that is ideal because it obviously leaves the interest gets paid, but obviously the capital, there's no amortization on that.
Just a quick one, James. What is the minimum Or maybe what's the classic candidate for that send product?
So for a send, we're talking, I would say, a minimum of, I've seen, so we've raised 200 million for this fund. I think the average ticket will probably be 7-8 million, but the smaller ones that we're looking at are 2.5-3 million. So they're normally existing businesses that are looking to probably ultimately borrow, increasing from, let's say, the 3 to the 8 million over a period of time. There are different businesses that suit that. We are quite big in financial services because we know that space extremely well. The cash flows are consistent, the contracts are consistent, etc. But everything from dental roll-ups to anything that's healthcare orientated, pets are obviously a huge one, funnily enough. But we're seeing all sorts of different types of market. SaaS roll-ups, technology roll-ups, it all comes through. And it's quite fascinating looking at the type of businesses that you see. We're definitely a good gap filler in the market where people don't know about. And I think that my biggest problem with this whole market in our lower mid-market space is actually access to the information to know where to go. And there are very few people at our end of the spectrum. So for that, we're quite unique. But a lot of the things that we're trying to do, and with you yourself, we're trying to put it out there that there are people who come from a entrepreneurial background who've been there, done it, and are looking to make entrepreneurial decisions into a credit space.
It's like optimists meet pessimists.
Correct. Absolutely. No, that's a classic. Yeah, I agree. And listen, I throw questions at me as we go because I'm quite passionate on it, but I don't generally stop on it. Yeah, you're right. I mean, that is a big problem. Optimists versus pessimists. Pest credit, I mean, I've never seen anything like it. But I think we have a fair balance. And I think what entrepreneurs have to accept is that if you take credit and lending, there is no upside in credit. You only have your coupon. That's all there is. Now, I mean, obviously, if you're in equity, you get the equity type returns. We've created two products to match that. We've got the core product, which is, as I say, the £1 to £5 million lending space, and it's 75% amortizing. We can tweak, and we've got a lot of flexibility around the structures. And just so you know, the average lending at the moment is around £1.9 million for that, which would be, if you want to put it in leverage terms, that would be about, let's say, average is 2.5 times leveraged, 3 times leveraged. So you can work out what the average EBITDA is for a business of 600, call it £600,000, maybe a bit more, is the average EBITDA for a business. But we've got flexibility. We've got add backs. We look at these things and work out how to make it work. I think that this is the advantage that SME has. We have the advantage that we can look at the business, evaluate, speak to the people. I'm still of the view, and this is obviously my optimistic entrepreneurial hat speaking, I'm still of the view that you'll make a decision in the first 10 minutes by speaking to the management, and you can probably get 80% of it both correct, but also 80% of it, you'll make a judgment call within that first 10 minutes. The rest of the 20% within credit is actually making sure that the figures add up and they are doing what they say they do. And I think we have quite a good balance between our credit team, who are institutional credit trained, and the entrepreneurial side of it, where you've got the likes of me who, don't want to sound too flippant, but I far rather buy people and what they're going to do and how they run businesses over some boring credit bloke who's just going to say, computer says no, because it doesn't fit the numbers. And normally it doesn't fit the numbers because it's actually the company at the top. So in this case, the bank, or let's say banks. And with banks, of course, everyone thinks, it's just that they don't like SME. It's not. It's actually down to the regulator. It's down to bank PRA. It's down to all regulations, tier 1 capital, things like this, things that have been brought in, whether it be from the EU, whether it be brought in from global banking regs, macroeconomics. They do forget that. Part of me has sympathy with the banks, but part of me thinks, come on, they've been the bread and butter in the UK especially. And I would say most UK banks have made so much money out of SME lending. It's the bedrock of UK PLC. So in terms of the buy and build, I mean, we see these daily. And some are exciting, some are not so exciting. Some people, need to think about where it's going. I have a general belief that if people have got that flair, they should be backed, and they should be, and we ought to be part of that journey. That's my gut reaction.
You raise an interesting point, James. So the balance between the entrepreneurial aspect of kind of backing the entrepreneur, and maybe, in those first initial conversations, you get an idea of what that person's like. So from my experience and people kind of in the network and the listeners, you get, a lot of them are pivoting from a corporate career to acquire a small business. And in other countries that, have also a robust kind of acquisition entrepreneurship ecosystem like US, Canada, Germany, a profile like mine or others like that, it seems pretty favorable for small business acquisitions because they arguably have kind of a well-rounded business acumen. But in the UK, it seems to be all bucketed as a management buy-in. And that sits at the lowest end of the risk appetite on any lender. So without having those conversations that you're saying that you do and SME does to kind of get a better feel, it's almost like, okay, you've never installed a window or a door. You worked at a marketing company, like we're not going to look at you. Or you worked in a bank, like too bad. How do you kind of think about that? And why do you think that is? Is it a kind of pattern recognition of deals gone bad, or is it what is it that kind of leads lenders to kind of take that approach?
Okay, so my take is that the Canada, US especially, it doesn't matter if you fail at something so long as you try. And I think it is I love the US. I love New York. Sorry, I love the US. That sounds a bit unpatriotic. I don't love the US at all. But I think I love their attitude. And I think their attitude to business is exceptional. They're goers, they're triers. I love that business ethic. And whereas if in the UK, I always say there are no salesmen left in the UK, which is a real shame. And by and large, there are few and far between. The US is converse. It is just sales. And sales needs to drive businesses. So you can mix the two together with entrepreneurialism. They've got to be able, so good salesmen can spot all sorts of different identities and different businesses and ideas. So why do I think the UK is so bad at it? Because we are naturally conservative by our nature. I think Englishmen or British people are generally very circumspect. They always would rather go on the side of conservatism, I think, as a general rule. I mean, so here's a very interesting bit. So we recently raised some equity, and I might add equity here, from so the company is effectively backed by myself, and I've put equity in, and debt, funnily enough, but that's for lending purposes. So I'm quite well entrenched in the actual debt of the business. So we went out. We've got 3 family offices, and between us, we own 100 businesses. Now, that is quite a rarity in itself. That is a definite rarity. I think that UK banks, because they used to be able to make calls on people because you had a relationship with the local manager. Now, the local manager has no control over it whatsoever. And I think the proliferation, and my hat's off, to someone like Funding Circle, who still took a long time to actually develop. They literally have backed on some spurious business startups, if that makes sense. They've definitely will back ideas so long as you can pitch the story. I think it's just the conservative nature of credit. I mean, if you look at the world's banking organizations, the UK has got some exceptionally large ones. And okay, HSBC used to be Midland Bank, but let's just say one of the world's largest banking organizations, NatWest, Lloyds, Santander, which is obviously Spanish, but obviously is here. We only have 6 major banks in reality. You go to the US, they have thousands of community banks, and Europe as well. It's no different. I think it's more the conservative nature. They never had equity in it, which is part of the issue. And this is why the proliferation of private debt funds, which always say that they don't take equity. Yes, they do in some format, whether it be a warrant or whether it be direct equity. You've got the proliferation of PE funds. I think we've been quite avant-garde with the style in which that we do back entrepreneurs. The only downside, I would say, for the UK and for you, Paul, is a very salient point, is that I think that we haven't learned to get, they'll back experience over anything else. So having experience counts for a lot. And there's something to it. Remember credit. It's like, or remember the expression, you can't be fired for choosing IBM. It's the same for a credit bloke. You can't be you've worked for Microsoft, let's use that as an example. Well, fine, you've got kudos now. You've worked for Microsoft or Google, or you've worked for whoever, a huge media business. You've got that. And that actually probably people do take comfort in. The funny one is I had about 2 years ago, we had a property guy who wanted to go into building of a SaaS business, buying up small SaaS businesses. And I said, what's your relevance to it? And he said, well, I know I can do it. I've got this business. The fundamental business that he looked to do looked pretty good. We had to say no, because the problem is when I went and checked his prior back book, he'd gone from here to here to here to here. And property was just the last thing in it. And in actual fact, we just had to do a bit of digging. I mean, I don't really know how to answer it other than say the UK as a general rule is conservative. We're trying to buck that trend to a degree. And we actually look at the people.
I think that's clear. So maybe a good follow-up question is, and I'll preface it by saying, like you touched on experience, you're never going to get fired for backing someone who has experience in the sector versus taking a risk. I think that's reasonable. And that's something I learned quite early on in my journey. I had great deal, great valuation, great structure, ticked a lot of the boxes, but, I maybe needed to strengthen up a little bit more of the incoming team and incentivize the existing team. So I kind of built out that piece and then brought it back to see kind of the appetite, and that definitely helped the conversations. So then what does make a good deal in the eyes of a lender? So you touched on kind of experience or incoming team. Is there obviously price would pay a piece, history of profitability? What are some of kind of those 3-5 things that anyone listening should know? Okay, it needs to tick these boxes so I can at least have a chance of this getting funded if I maybe don't come from the exact same background as the target company.
Okay, so that's a very interesting point. So what we're looking for and what people are looking for, they like a team. They like the quality of the individuals. They like to see track records or experience that's related. And we're a cash flow lender, not an asset lender. So we're looking for cash generation. You're looking for the multiples of the business that you're paying for, what it's generating, what its debt serviceability is like. So let's put that into examples. You're buying a business that turns over £2 million and makes 500,000 for argument's sake. So that's quite a nice margin business like that, 25%. Now, that's quite a more what I would call a service-related business. That's probably fairly stereotypical. Then in which case, there's a lot that you can work out. How are you buying that business? So you work out, the guy says, I want 10 times, so I want £5 million for business. Well, I can tell you can want that, but the reality is a business like that, subject to the contracts, the reality is that business is probably worth no more than 2.5-3 million quid, depending on even what the value of the contracts are. And I think businessmen / entrepreneurs have this. I go back. I'm 52 years of age. I go back to 30 years ago. And I would say, people say, well, might as well just keep the business because in actual fact, my income generated from it is 10%. I'm making X £100,000. And so you'd have to pay me 10 times, so 10%, so I can get 10% off my money. But the reality is yeah, it is. I mean, they literally have this very, very, very bog standard view of life. The reality is that it's not how it works. I would argue that somebody who's exiting normally wants to exit because he's either retiring, ill health, bored, or they can't actually grow it anymore. That's as a general rule. Okay. What we're looking for is, so somebody track record is very good in watching these businesses, and you sometimes they've made 250, sometimes they made 500, then 350, blah blah blah. And so what you're doing is you're averaging out. And for how we would lend against that is you would average out what that is. You lend a multiple, which we don't do, but we sort of play at it. We're not corporate finance advisors. We know roughly how. So one of the things that we're doing is we do have a lot of relationships with corporate finance advisors. And I think it's to get the structure of your purchase correct, i.e., rather than someone saying, oh, I want 100% up front, which of course most people would want 100% up front. No, I mean, how it works in the IFA space is really simple. You pay people 50% of whatever the value is that you agree up front, and then it's either a 2, 3, or 4 year earnout predicated on the EBITDA being maintained. Now, a lot of people say, oh, well, yeah, but I'm not involved in the business anymore. No, but that's the risk that they take with how to protect the revenue. So there's combinations. If you're a good quality team in terms of an MBI, then in which case it's down to you to say to the guy, okay, fine, but I can put protections in place for you, exiting shareholder or vendor. This is exactly how it works. This is what we can do. Maybe you can hand over a period of time, and you pay them a consultancy fee to hand it over. Things like that. And I think it's a sensible approach. That's really where it comes from. A sensible and pragmatic approach. And if you've got a willing seller, it makes life a lot easier.
Yeah. In terms of expectations, structuring a fair deal, transition period, all of that, like you touched on it. I think probably, without the point of it helping you get that cash flow lend that you may need, you probably don't want to actually acquire the business if those things aren't in place anyway, because, the risk pretty asymmetrical at that point.
Absolutely. And I think it is, I think this is back down to entrepreneurialism. I think you look at a business, you can work out what you can do with it. And it is only, a business is only worth what somebody is willing to pay for it. It's like a house or any other asset for that purpose. And just because one person thinks it's worth X doesn't necessarily mean to say the market will physically pay that. And I suppose that's just general capitalism. But from a borrower point of view, if you're borrowing to buy into businesses like this, or borrowing as a business to try and progress, these are commonplace and sensible. We're not taking an equity position. If you want equity because you think that you can do X, Y, and Z, somebody's got to have return that is proportionate to risk. And I suppose that's probably where I've moderated my optimistic side over the last 5 years, 6 years, is that I actually realize that it's all risk-related returns and risk-relative returns. We are not in equity. Well, in Ascend, we have a small warrant in place, which is based on the growth, and that's part of tied into the risk, as it were. But in terms of our standard core product, no, we get paid a coupon of 8 to 11%, somewhere in between, subject to whatever the terms are, and the relative risk, and that's all we get. So you have to make a very sensible decision, and part of this is actually having a good relationship with the management and understanding that bit too. And hence why I go back to 80, 90% of the decision can be based fairly quickly on gut reaction of that person and that team.
And going back to the default rates you quoted earlier, kind of sub 2% or probably even sub 1% for the market where your sweet spot. I mean, risk adjusted, those returns are great. If I think of back in my day investing in high yield, I think like 6-7% default rates, if you're thinking globally.
Globally, if you're talking about EM stuff, yeah.
Yeah, not substantially higher returns. So.
Correct. I mean, if you look at it where we are now, I mean, let's just say you've got a 9% loan for argument's sake. I would argue that 2.5% to 3% of that is illiquidity premium. That's part of where it is. If you went to get a loan from the bank today and the banks were willing to give you debt, you would probably still be paying 5%, 6%, probably even 7%. So at the moment, on the risk scale, I would say we're still pretty cheap, actually, because at 9%, because you're down to a 2%, 2.5% illiquidity premium. When, if I go back to 2015, people wanting 5% illiquidity premium. So that's quite a fascinating trade. And we have to balance these off, because I have to get money. I have to get 200, 300 million every year to put out through the doors. You have to take out what capital markets want. What are they looking for? and what can also be put in there. Because just because base rate is on the floor, okay, not at the moment, but I mean, it's not far off, and I suspect it won't rise that much more. But what you're paying for is a completely different space in the market. We're not talking about institutional corporate bonds or government bonds, govies. So we are in a different world. And I think that's the educative bit that we're doing with a lot of SMEs to understanding it. But what we can probably do in that process is help them understand where they're going and what they want to do. Yeah, I don't get off on lending people money. What I get off on lending people money for is to do something with it. There's an activity, there's an action that's going on. It might be a cash out. It might be an MBI. It might be an MBO. I think that is the key bit to it, is there's activity. And I like to see people are progressing stuff. I mean, I'd love to have a business that sits there and just spews out cash every single month, month on month on month on month, with no risk. It'd be great. It just doesn't happen, though. I haven't found it yet. And the moment I do, I won't be telling anybody.
Excellent. Yeah, this is really helpful to kind of get a sense of, the Genesis SME, kind of the unique approach it takes in the market, what you look for in kind of entrepreneurs or businesses or anyone that's looking to kind of grow with some debt capital. I think maybe a couple of important pieces that probably we didn't touch on specifically, but I think from what I've seen across the market is you guys are sector agnostic. I think that's can be somewhat unique. Your sweet spot is probably more targeted to the acquisition entrepreneur or small business. A lot of the times, the minimum loan sizes for the low middle market lenders are not too low, where I think is you're kind of taking a more entrepreneurial approach and comfortable going down to 500,000 loan quantums, which I think is really fascinating. I wanted to spend a few minutes on Titan because I think what you guys are doing there is interesting. But is there any last thoughts for the listeners who may be thinking out to reach out to SME at some point on a potential deal? Anything you want to leave with the audience on that?
Yeah, I think the bit that you said, I mean, agnostic on sector. We are when I say relatively agnostic, I think you've got to put it in context. We're agnostic because we look at the cash flow. So if you're cash generative and you can predict, it's predictable cash flows. I don't care whether you're in retail on the high street, which obviously for the last 5 years has notoriously been going south, or whether you're in healthcare where or let's just say you just use COVID. You've been a supplier of COVID paraphernalia, whether it be masks to sanitizer. We look at that and you go, and I've seen, by the way, a couple of these. I've seen cash outs on COVID stuff. And you go, oh, well, our turnover rocketed to £17 million and our profits were 16. And you go, yes, but where are you going forward? This isn't going to maintain. It was a spike. What we ask for is what the look back was. And you find that in actual fact, they were turning 2 million quid and making 500 grand. And you say, great. So let's go on this then. We'll base it off. We won't even use an average in this case. We'll base, because all they're trying to do, they're very cash generative. But I'm not going to give somebody a loan predicated on the fact that even if the average was 8, they can have 8 million out. Absolutely not. And likewise, conversely, just because they've been suppressed in retail, if they've got some retail, I can tell you an interesting space is the vape space. It's going very retail. It's growing like that. And it's got all the hallmarks of, it's all retail. It's all retail. There are unbelievable opportunities there in terms of developing that out. Even I've looked at, I don't vape, I don't smoke. I have done in my past, but I don't. It's like Bill. I'm an entrepreneur and I look at it. I walked down Baker Street the other day and suddenly there's this shop on the left-hand side of the road that says, or on the right side, that looked like an Apple store. And I go, holy shit, this is unbelievable. And it's all white and it's all very smart. And there's nothing but thousands of different types of vape in there. Anyway, I've got a friend of mine who's in the game. He said, yeah, you'll see them popping up all over. The disposables are huge. And what I'm saying is things like that. You've then got to manage that. What is that? Is that growth capital? Or is that provision to buy and build? Is it just to help develop the businesses? One store goes into another. Is it another? They're very cash generative. So what I'm looking at is, go back to it, I'm sector agnostic. Actually, Better be careful there, actually, because the compliance police might tell me otherwise. We obviously have to avoid all the usual non-guns, weapons, things like that. I mean, we're not in anything that's deemed ESG is the wrong, socially responsible, I think is probably the best description. And vaping, I think, it falls outside that, so that's fine. But it's about cash generation and managing expectation as to what is capable. What I do know is that we are the only people who will probably lend to it. That's what I can say.
Okay. Very helpful. So like I said, I just wanted to touch on a little bit on Titan. So if it wasn't enough that you were kind of taking an entrepreneurial journey, launching SME, a bespoke lending company, which in my head, just thinking of kind of compliance issues, and you touched on a few things that would give me nightmares, you decided that you're also going to launch Titan Wealth Holding. So maybe you can speak a little bit about that and the opportunity you saw to kind of, launch Titan.
So Titan was born out of a very simple perspective. I was born in a world of IFA roll-ups. So Pantheon was an IFA roll-up. It's probably one of the original consolidators in the space. I then got involved in a business with a friend of mine called Andrew Fearon, who developed IWP, so Independent Wealth Planners, which has done 36 acquisitions in 2 years. Now, for something like this, you need a big backer with you. And okay, let's be brutal. It's knowing where to access capital. And I would argue that through my early, up until I was 45, I wouldn't have a clue. I didn't have a clue. Even though I was in financial services, I had a relationship with the bank. I could do this, that, and the other. I thought I had access to capital. Anyway, I met Andrew. Andrew put me on the board of IWP. And about 2 years ago, we were sat in our garden in lockdown, not a la Boris Johnson. We weren't having a party. We were just having a business meeting. And I had another friend of mine who was selling his business in the trade custody and settlement and platform space, which for most people who don't know, basically means clearing and custody of assets in the liquid markets, whether it be stock market or bond markets. And we realized that one of the things that isn't happening in this space is there's no consolidation of discretionary fund managers, or DFMs as they're called, and the services and the utilities that they provide. And IWP was running its course, the M&A was going on, there was a team that was physically doing it. So he and I said, why don't we go and borrow a whole load of money and buy up a whole load of DFMs? Which on the face of it seems really easy to do. So we went to the largest lender in the world, which is Ares, a private debt fund, and we said, could we have some money? And we had an advantage. We had an advantage in that the backer of IWP was Ares. And we used our leverage there, and we said, look, this is what we're trying to do. We want to go and... So they gave us a facility of £170 million at outset to go and buy 3 businesses. We went and bought those businesses, which wasn't quite as easy as it sounds, but I mean, we went through a whole process. And this is the area where you go into full-blown institutional DD. We had EY, we had PwC, we had Deloitte reports. So you had 3 of the big 4. I mean, our fees were, forget it, absolutely gigantic. We were running 3 acquisition processes for day one lend. So day one of our facility, we spent £90 million in the first completion. And ironically, 2 weeks from the end, we didn't complete on one of the transactions. It dropped away. So I ended up with £500,000 of fees that sat to Andrew and I. Anyway, cut a long story short, we purchased the first 2 businesses. It sits in a very sweet spot of institutional DFM management and the utility services of trade, custody, settlement, and platform. And we now have our own platform with over $3.5 billion of assets on it. And we have an asset management business, which we purchased at the same time with, can't remember, somewhere in the order of around a bit more, because we then subsequently bought some more, with about $5 billion of assets, something like that. So I think we're up to about $7.5 billion of assets today. We've created the core part of our business, which Titan has effectively 2 platforms, a DFM platform for external use and institutions, and we have what's called a wrap platform for the IFA world. And then we have 4 key purchases that we've done. We have an active passive business, ETF business. We have a fund of funds business. We have an equity business, and we also have a alternatives business. So we have the core. We started with, so day one, this is to put it into context, we started with 10 million of EBITDA day one. 10 months later, we now have 25 million of EBITDA, and we're on a run rate of about 43, something like that. We have 2 other equity parties in there on top of Aries, and Andrew and myself are excluded from that, but we are in the equity. And Aries are our backer. It's a far cry from SME. It's a world which is very much institutionally driven. You have to choose IBM to tick off all the boxes. You pay fortunes in fees for the same bullshit. And please don't quote me on that.
We'll beep that.
We'll beep that. Yeah. But it is a very interesting way of accessing capital. We will probably have, by the end of next year, I suspect we'll have about 50 billion of assets under Titan, and we will have grown to 100 million of EBITDA, somewhere in that order. Now, the interesting bit to me and why I'm able to do both is both of our businesses, both SME and Titan, are based out of the same building. I've got a CEO who you may know, Ronnie. Ronnie is come on now to run as CEO SME. We literally backwards and forwards across the, I won't say across the desk, but not far off it, across the office. We are trying to create a semi-retail product in SME, which is basically a high-yielding fund. And we will utilize that in part of the alternatives bucket within Titan. And it means that we basically have captive cash that we can utilize. And dare I say it, I want to help and roll this out so that we've got more access to capital to help entrepreneurs. And you can have different buckets. You can have very boring money. You can have sort of middle exciting money, and you can have PE type money. But I'm not saying I never want to run a business in terms of be a PE in a business. I don't mind having some equity upside in the trade, but I don't think running businesses. I have a view. Most people who run PE firms have never run a business. Big difference. If you're going to be involved, I don't mind making judgment calls on people to run money and deliver the entrepreneurial returns that people look for. And so we have different risk buckets, and SME will provide risk buckets for Titan and to sit on. And I think that's quite exciting.
Yeah, incredibly exciting. And the link there with that high yield fund. And yeah, I didn't realize that. And even going back to Titan itself, I mean, like coming from that world for the last 10 or so years, I actually worked as a discretionary fund manager, managing the discretionary assets for private clients and institutions. And maybe I can beep this out. I don't know if I can share it, but JP Morgan's business covering EMEA was around 30 billion in assets under management. And what would you consider as kind of like one of the leading private wealth management players? Like you're on track there to do that via acquisition while adding on not just the AUM, but the services component to it. It's just incredibly impressive.
Yeah, I think, and I mean, here's the irony. In our warehouse, which is our core product, JP Morgan, as you may or may not know, are effectively the 75% lender in that bucket. So you have a conduit, or you had a conduit financing vehicle, and I don't know how big it is. I think it's about 4 or 5 billion of assets. We're hopefully taking 200, 300 million a year off them for that purpose. What they ultimately do with it is, who knows? They'll sell it into the market, et cetera, et cetera. What I want to do is almost bring it to access. I'd far rather, why don't whether it be high net worth or retail investors, have it in some format that they can access decent returns. And they're actually reinvesting back into either local businesses, but diverse spread. Even if we've got, I mean, every warehouse that we do will have 80 to 120 names in it. That's quite nicely diversified.
And not overly so. I think it's a kind of perfect concentrate. Yeah.
Yeah. No concentration. Risk is, you're senior secured across all those assets.
Yeah, incredibly interesting. I mean, I just want to be cognizant of your time. I know you're a busy guy, and kind of we've been chatting now for almost an hour, but this is incredibly interesting, James. It's been a fascinating discussion. I'm glad we got to touch on Titan there for a little bit because I think what you're doing there is, I mean, I didn't know the scale of what it was, but it's incredibly impressive. So maybe kind of in a year, well, you said even less than a year, but maybe sometime down the line, we can chat to you again when you've scaled it up to kind of 50 billion and get some more of your insights on that. I think that would be super interesting. I don't know if there's anything you want to leave with the audience, any messages, way to reach out, anything like that. We obviously touched on this a little bit for SME specifically, but, feel free to have the mic for a few minutes and, lead the audience with anything that you would like to.
Okay, well, thank you very much, Paul. That's been great. I mean, I run an open door policy. I mean, I sit as chair. We've got a great team. I think we're about 25, 26 now within SME. We obviously have a website which people can come through, which is smecapital.com. I think my email is on there. I think the one thing that I would say is that we are well and truly, I won't say open for business because we've been open for business for some time, but I think we'll listen to and try and deliver what I would call, we'll listen to what people's stories are before you make a decision on the numbers. And I think that's always the interesting bit to it. I'm not going to prejudge anything. Fine. Actually, that's not true. I will prejudge something that is just absolutely too far out there, but I'll at least have a conversation, or our team would have a conversation to say, stop being unrealistic. But if people understand what general lending parameters are, and they are very simple, they are up to 3.5 times leveraged. I don't push it all the time, and that's leverage to EBITDA. If people understand how to structure a deal, and they understand what they're buying and adjustments that can be made, we can work together to sculpt deals. Deals don't have to be black and white. It doesn't have to be a 5-year term loan fully amortizing over the period of time. There are ways and means of doing it. MBOs require, and MBIs generally require the first year to be interest only, because they want to store up cash so that they can utilize that to develop working capital, to develop out their business, what their next acquisition might be, or whatever the capital expenditure program that might be there. We can work with that. There's no problem. It's called having a conversation. And I find that one of the biggest things that we really need to do is that we need to engage with borrowers earlier, have conversations, and set expectations. So one of the things I would love to do is talk about in future episodes is maybe go down a vlog of literally step by step walking through different processes. It would be a great way of doing it. And I hope, I don't want to sound condescending, there is an education in 1, knowledge, where do I go? And 2, how do I do it? And I think if we can start on that messaging, Andrew, who's at our end here, is trying to get that message out for us, and you are obviously trying to get that message out. I would love to work on that basis and to speak to borrowers directly, present to them. Vlogging to me is blogging. They're essentially going to be essential parts. So we're open doors policy.
Absolutely. I have some thoughts on that. I can chat you for a minute when we jump offline, but this has been an excellent episode. James, I appreciate you taking the time to chat to us and appreciate you sponsoring the podcast. And yeah, very interesting what you guys are doing. I hope the listeners, well, I'm sure the listeners are going to take a lot out of this, and hopefully you get some interesting inbound entrepreneurs with some fascinating deals that you can back.
Fantastic. Thank you very much, Paul.
Thanks for joining us for this episode of the Buy and Build podcast. If you enjoyed the episode, please follow the show on your favorite podcast app to stay up to date on all new episodes. If you would like to support the show, please share it with others you think might be interested.
You can also join the Buy and Build community at buyandbuild.co, where we plan to share additional resources and ideas with this community. You can also find us on Twitter at